Welcome, everyone, to the Information's TITV. My name is Akash Pasricha. It is Tuesday, August 18th. Today on the show, we're going to take a look inside Uber's business and what investors might be missing about the stock's upside. I'm then sitting down with the CEO of Twilio to talk about the reacceleration in the company's business, but also where it goes from here. And we're going to close out the show with some new data on why AI infrastructure companies are the fastest growing pocket of the sector right now, ahead of AI applications. It's going to be a great show, so let's get right on into it. Uber shares are down 8% this year, but the Information's financial analysis columnist Anita Ramaswamy put out a column this morning suggesting that investors may have it all wrong. I want to bring on Anita to walk us through her thoughts. Anita, welcome back to the show. It's great to have you here.
Happy to be here.
Okay, so you pointed out in your column that Uber is trading at 2.6 times revenue, which is really low for a tech company. I mean, I was shocked to see it was trading that low. What's the story here?
Yeah, it's a good question. Just to put the number into perspective really quick, Akash, Uber is trading at 2.6 times next year's revenue on an EV to revenue multiple. If you look at some of the rivals, the whole ride hailing sector, if you take just Uber and Lyft, Lyft is also trading at an even lower multiple of forward revenue. But then if you compare this to some other players, like let's take DoorDash, for example, they're trading at a closer to 5 times multiple. And so some of the biggest factor behind this, which you asked about, is actually the concerns that Uber is going to become less relevant in a world where everybody's taking a robotaxi. So a lot of it has to do with Waymo's rise and some of the concerns about how that might affect players like Uber and Lyft.
So let's unpack this a little bit more. I mean, we'll talk about delivery in a second because I don't know that people are eating a whole lot more today than they were a couple years ago. But what are the concerns here with autonomous vehicles and how that's going to affect ride hailing? Because it's not like they're everywhere right now, right?
They're not everywhere, but I'm reporting from San Francisco. It does feel like they're pretty ubiquitous here. I also am from Phoenix, which is a place that has had Waymos for a really long time, actually even before San Francisco. And so these autonomous vehicles are really sort of infiltrating city after city in the US. And for people who are in the markets that Waymo does operate, they're pretty commonplace. And so I think the big concern from a lot of investors and a lot of folks who have taken a Waymo, maybe seen them around their neighborhood, is the idea that people are just going to want that experience. They're going to want to sit in a car without a human driver, that they might feel is safer, and that that's going to be the future of the industry. And so that begs the question, well, where does Lyft or Uber, like these kind of traditional ride hailing companies, get a slice of the pie? Now, the challenge for Uber is that they have positioned themselves as sort of a middleman. They used to have this sort of project where they were building their own autonomous vehicles, and they abandoned that effort back under their former CEO. And so they've decided to take this approach where they are taking all these other robotaxi companies and using their platform to put supply of those cars onto Uber. So they had some partnerships with Waymo like this, and they still do have some of these partnerships, but some of the partnerships have started to fray. We heard earlier this year in March that Uber and Waymo were actually ending their partnership in Phoenix. And then in Austin and Atlanta, you used to be able to, and currently it's still the case, that if you want to call a Waymo, the only place you can do that in those cities is on the Uber app. But recently, we heard news that Uber has chosen to amend its partnership. And so starting in 2028 in Austin and Atlanta, you'll be able to call a Waymo not just through the Uber app, but also through potentially other apps, most likely through Waymo's own app. And so I think investors and the market broadly are just concerned that if these robotaxi companies such as Waymo that are actually building the autonomous vehicles are able to launch their own apps and get their own ridership, where does that leave Uber? So that's the big question.
So this is kind of interesting, and I do recall when I was in San Francisco last, I called the Waymo through the Waymo app, not through the Uber app. I don't even know that I looked really. I just wanted I wanted the full Waymo experience. Okay, I was in San Francisco. I just wanted it, but
Well, and in SF, you can't call it through the Uber
oh,
app.
you
It's not one of
can't.
the cities with
Oh,
partnerships.
okay.
Yeah.
Oh, okay, well, there you go. Maybe that's why. Um, so then if they're if they're walking away from that integration a little bit, bit by bit, what are they replacing it? I mean, tell us a little bit about their autonomous vehicle strategy then broadly.
Yeah, so Uber and Waymo, I mean, the thing is that Uber doesn't necessarily need Waymo to succeed in the robotaxi race. Uber has dozens of partnerships with all of these other autonomous vehicle firms, and we haven't really seen them because a lot of them haven't come into fruition yet in terms of actually getting vehicles on the road. But one of the more notable arrangements that Uber has is its partnership with Amazon's Zoox. So Amazon has been testing these Zoox vehicles, their own self-driving cars, all over San Francisco. They are expected to launch at some point soon. And so those vehicles are going to come onto the Uber platform. We have Uber's partnerships with Wave, which is a UK based ride hailing company that is working on robotaxis. And so, in all of these other markets, I think especially globally and not necessarily so much in the US, Uber has already started deploying some of these cars on the roads that are built, manufactured, and maintained by a third party, but they're available primarily through the Uber platform. And so I think that Uber ultimately is going to be a successful middleman here. There's a lot of middleman businesses that have succeeded
Right.
over the years.
There was also the Neuro was another company, right? There was a I forget the third company, but we had the
Yeah,
Neuro CEO on the show. There was some partnership there as well, right?
right. Lucid Motors is making the
Lucid.
actual vehicles, and then Nuro is outfitting it with the autonomous driving technology. And then Uber is making them available on its platform.
Right. Okay. So, but okay, just to play devil's advocate here, I mean, all these companies that Uber is partnering with, I mean, you could make the argument that those exact companies then could pose competition to Uber as well, right? I mean that if Uber and I mean, look, this is the thing. They tried autonomous vehicles themselves. They've gone more the partnership approach. I wonder to what extent you think it puts them at a disadvantage not owning the IP or the stack in autonomous vehicles, or I don't know, maybe this is the more profitable way to do it.
I actually think that's the key, Akash. It's a huge advantage in my books because it allows Uber to be really capital light. They don't have to invest a ton of money in the sensors and the testing and, sort of commercializing the vehicles in the same way that a Waymo does. We still don't even know the extent of profitability on the Waymo vehicles. And the LiDAR sensors are super expensive. The hardware in general is super expensive, which is why still today, oftentimes, if I call a Waymo, I'll see that it's a little bit more expensive than a traditional Uber. And so I think this is a cost advantage for Uber and a more profitable way to grow. You're correct to point out that Uber will probably face competition from some of the, operators that decide to do their standalone apps like Waymo. We're already seeing that. But my point is, I don't think that passengers really want to download 15 different apps for 15 different, autonomous vehicle companies. And the way that this technology is developing, obviously Waymo does have a lead, but at the same time, they're not in a lot of key cities. Like Waymos are not on the roads in New York. Waymos are not on the roads in some of the major US cities or major cities around the world. And that's a lot of white space, frankly, for not just Uber, but for other actual robotaxi manufacturers to go and capture a slice of the pie.
Right. Let's talk about the delivery business. This is what you call out in the column as the biggest opportunity for Uber. Why do you think investors are underappreciating that segment of the business?
So when I was looking at this, the main framework I was looking at was actually comparing Uber's valuation to that of DoorDash. And if you look at where DoorDash is trading right now, DoorDash, primarily a food delivery business, like that is their bread and butter. That's what they do. Whereas for Uber, you have the ride hailing, and then you also have the smaller um, sort of food delivery business that has been growing really fast and is increasingly a larger part of Uber's revenue and its profits. DoorDash is valued at around 75 times their earnings in 2025. And so if you apply that 75 times multiple to Uber, you basically get the value of their delivery business just for Uber's delivery business alone, because Uber does report, separate financials. So if you apply that to Uber's EBITDA, you get a $270 billion valuation. So for context, Uber's entire market cap right now is just around 150 billion. So that
So
suggests
the
to me that
deliver the
the market
delivery
isn't counting.
business. So if you just value the company on the delivery business using DoorDash as multiple, you get a bigger business than what the market is giving it right now.
For all of Uber. Yes, that's
Yeah.
correct. So something is missing here, right? Either we're
I mean, autonomous
on
vehicles could
delivery.
easily deliver your burrito too, right? Like that could be the future.
Yeah, yeah, and Uber Eats is growing really fast. I mean, the delivery business is primarily Uber Eats is the growth engine there. They grew 28% top line in the last quarter. They have been posting, mid to high 20% growth rates for the last several quarters. They are expanding really fast. They are seeing a lot of success across the world. And I think, DoorDash has a pretty high multiple, One of the reasons I think is because it's, more visible in the US. It has greater market share than Uber Eats, but Uber is the dominant market player in most of the world. And so most of these markets, they're seeing a lot of success. They're also growing really fast in the United States too. And I think people often forget, we think of Uber as this traditional ride hailing business, and that's where they kind of got their start. But over the last several years, they've been really aggressive in terms of delivery. And
Right.
there seems to be a lot of demand for that.
I mean, yeah, more what I was saying was it seems a bit unfair that investors have punished Uber alone for the autonomous vehicles threat when I mean I actually think it's much easier to uh, get burritos to people autonomously than ride hailing people around. So I mean, you would think maybe they would apply some equivalence there. I mean, just to give DoorDash its fair due here, is that company doing something especially well, perhaps on their financials or strategy that has afforded them that premium?
I mean, DoorDash is growing super fast. They're growing faster than Uber actually overall, and they are investing in what you talked about in autonomous delivery. So I think they're staying competitive. They've been very clear, management there, that, we are going to be investing, we're going to be spending CapEx, but this is for the sort of autonomous future that they're building towards. So maybe they've taken a little bit more of a hands-on approach, whereas Uber has decided to take more of the middleman partnership approach. But at
Right.
the end of the day, both companies are sort of in a similar position, like you mentioned.
Right. So, Anita, I mean, if you had the opportunity to sit down with Uber's management, and I trust you asked multiple times, as we often do for these types of stories that give us some time with any executive, what would be the top of mind questions that you would want to ask their management?
I would wanna ask about the, sort of, failed or, abandoned attempt to build Uber's own robotaxis, and I wanna better understand whether as the market starts to develop and the cost of these LiDAR sensors comes down, is this something that Uber would ever consider reopening? I think there's some potential advantages in the sense that it could help Uber sort of get ahead of competition in the future, but then on the flip side, it would be super costly and expensive. So I would be really curious to know whether management sort of regrets having ditched that effort earlier under Travis Kalanick and whether it's something that they would consider reopening.
Great. Well, Anita, I want to thank you for coming on. That is Anita Ramaswamy, our financial analysis columnist here at The Information. We've talked about how AI is an inflection point for many software businesses, but one company we haven't talked about as much is Twilio. The company's business has reaccelerated dramatically over the past few years. Chances are you've probably interacted with their technology at some point. If you've ever gotten a text message from a business, I want to bring on CEO Khozema Shipchandler for a conversation. Khozema, welcome to the show. It's great to have you here.
Thanks for having me.
All right. So you took the job 2.5 years ago, as CEO, I should say. The company was growing at around 4%, its top line at that point. It's now growing at 22%, which is a pretty impressive reacceleration here. Take us inside the business. What has accounted for that reacceleration?
Yeah, I mean, a lot of it is just kind of starting to do what we said we were going to do. We put like a really, really deliberate focus on honestly just kind of running the company better, trying to reinvigorate the innovation engine, being really financially disciplined, and then, kind of running the place with a little bit more rigor. To be a little bit more specific there, I think some investments that we've made, especially more recently, in particular in using our communications products, which I think probably most of your listeners are most familiar with, enriching those with data. Like we launched a conversation suite at our most recent Signal customer conference. I think that's really gotten a lot of attention and excitement from customers. And then, as the company was originally born, I wasn't there at the time, but I think one of the things that we got a lot of credit for was being one of the original API companies, really leading with product led growth. We've spent a lot of time investing back into the self-serve channel, really reinvigorating how a customer approaches Twilio, gets started, and then can grow from there. We made some really specific investments there as well, and I think those are starting to pay off too.
But so the last 2.5 years, is this just more businesses that are needing, sort of these communications products, or has it more been your upselling them on more services?
I think it's kind of a combination of three things. So I think the first is that how do you continue to build great experiences with your existing customers? And so I'll give you an example, right? We had the PGA of America. This is the Professional Golfers Association for the pros, the 30,000 golf pros all over the US. They'd been a longtime customer of ours, and we saw an opportunity to expand our relationship, drive greater ROI for the PGA. And, we were able to get their team excited about that arrangement. And so we were able to grow that customer relationship. Or take a more recent example, like a car finance 24/7. They're a company that's based in the UK. They interact with their customers through a lot of our voice AI and other AI technologies. With the advent of AI, they wanted to be able to go a little bit further, use some of our conversations tools. They were a beta customer of ours. They wanted to grow with us using existing technologies and then improving upon those. So I would
So,
say,
this is like customer service conversations over text message or through voice, or what exactly does that
a bit
mean
of both.
expanding?
So depending on the customer that we're talking about, it could be text, it could be voice. In this particular case, it's voice.
Okay.
It's also what happens is like what gets lost in kind of the AI conversation sometimes is like, as cool as these tools are, like to really be able to get them to work appropriately, like you've got to capture context. Like if you don't know a lot about the consumer that you're interacting with, if you can't drive down model cost by
Yeah.
also just like getting to like that specific consumer record versus, scouring the entire history of the internet, like it's not a great ROI. And so what we've spent a lot of our time on is making sure that our customers are able to get intelligent during the course of an interaction. It could be text, could be voice, and then also be able to capture aspects of that conversation to turn it into memory so that our customers can then create a lifetime conversation with their customers. And so I would say some of our more context rich products have
Right.
gotten a lot of traction, and that's been really exciting. And then I would say, AI more recently, it's kind of a smaller part of the story, to be frank. I mean, certainly there's some tailwind there, but in terms of revenue contribution, pretty early days, but we're certainly excited about what that could become.
Meaning like, this is like the whole trend that, oh, is an agent going to communicate with you by text message or
Yeah,
something like that?
exactly. I mean, you can think probably in your last 12 months, like the number of interactions in which you've actually interacted with a truly virtual agent in a
Yeah.
sales call or customer service call. My guess is for you, it would be less than 5 times. I know it certainly is for me. So we haven't really seen that stuff take off. It will, and I think that's going to create some tailwind too.
Why not? Why not though? Why don't you think it's taken off? I mean, should we have? I don't know. Maybe we should have expected it to go faster.
I think it's just like anything. I mean, the technology adoption cycle like starts slow, goes super fast, and then kind of,
Right.
goes asymptotic at some stage. I think what we see in our own business is that if you're in retail, e-commerce, rideshare, food service, those kinds of industries, like you're prepared to experiment pretty fast. I think the stakes are a little bit lower if something goes slightly awry. I mean, never want something to go wrong, obviously, but stakes are a little bit lower, but the ROI is tremendous. And I'm not just
Yeah.
talking about the cost side. I'm talking about our customers' ability to revenue uplift is pretty profound. I think if you start talking about like regulated verticals, things like healthcare, financial services, insurance, it's pretty slow, like very, very heavy experimentation. These are super sophisticated users, but they cannot have something go wrong. I mean, that's a bad day if they have a hallucination of some kind in those kinds of environments.
So here's the big strategic point that I'm trying to wrap my head around with you guys. I mean, you've accelerated the business nicely in this communications software segment. There's a lot of discussion. The earnings call. I mean, the analysts admit AI could be a tailwind here if agents take off in the way that they do. You're expanding the business into this customer intelligence vertical. I mean, communications, I imagine, it's hard to work with telecom companies to, get phone numbers. I mean, this seems like a pretty arduous process that, has a bit of a higher barrier to entry. In communication in customer intelligence, I should say, I mean, that's a pretty crowded area as at least as far as software goes. And so it sort of feels to me like you're expanding into what is a more crowded segment. Why expand there at all? I mean, why not just double down on communications? And I don't know where you take the product, but I'm just help me sort of rectify these two realities.
I mean, I don't think they're in conflict. I mean, I would say, maybe why not do both, right? Like, I think we can win in communications already, expand our existing footprint. As you said or suggested a second ago, this is a problem that's been solved that is very, very difficult to AI your way to. It's physical, it's regulated, it takes an enormous amount of compliance work. It's phone number by phone number, use case by use case. And so I think that creates just a heck of a moat. We have an existing customer data platform product that we use. The focus in some ways is less on winning in context per se, but instead enriching every one of those conversations with context and then combining it, with AI capabilities on the other side. I think the most important thing for Twilio, honestly, is to operate as a sort of Switzerland, right? So, in other words, if you've already selected your LLM, if you've already selected a voice AI product, like that's okay. I mean, you're still going to end up utilizing Twilio's rails. And so we're going to be able to grow off of the success of your business in that way. There are going to be many other instances in which, and we see those today, where customers want a full stack solution built by Twilio, and we're going to offer that also. And then there are going to be some tweeners, right? So I think what we want to be able to do is basically meet a customer where they are. And in many cases, they have made decisions already about their technology stack, and we just want to be able to make it easy for them to integrate Twilio. We know that they need communications infrastructure to be able to reach their customers on the other side. We know
Right.
that we need context to be able to do that in a smart, not generic way, and to really be able to create these lifetime experiences. Increasingly, what we're seeing, at least based on our data, is they're going to come to Twilio for that and then augment that with all these other great companies that are out there. That positions us very nicely because it doesn't put us into direct competition with anybody, but instead allows us to complement existing offerings.
Have you heard of some of these smaller companies, the Interaction, yeah, Interaction Company, and then Link is another company. I've seen them pop up. These are sort of the iMessage native communication startups. I mean, is that class of startups that I guess this would be a group that sort of avoids SMS communications. They sort of leverage iMessage and maybe WhatsApp. Do you see that as a threat to your business?
I've know them. I've heard of them. I don't see it as a threat as much. I mean, I think the reality is that in the US, SMS is by far and away the most ubiquitous form factor. I think you see the same thing internationally. I mean, I think it's kind of interesting, right? Like in the US, while there's, I forget what the number is exactly, like let's say 75% iPhone penetration, you do run into interoperability issues if you go entirely Apple Message. Apple, rightfully so, is also like very, very strict about their privacy protocols, which we take quite seriously as well. And so I think a better solution is the combination of Apple Business Messaging with something like RCS, which is the Google offering. And I think only Twilio can really
Right.
drive that interoperability. And again, I stick to what I said a second ago, SMS is still the most ubiquitous. Outside the US, if you think about like peer-to-peer communications, and I'm sure you communicate with folks outside the US using WhatsApp, it's a great tool. It's obviously free. We support WhatsApp as a channel outside the US. I think in our experience, Mexico and Brazil tend to be the most dominant users, and in particular of WhatsApp voice, a little bit on the messaging side. But even in international markets, SMS tends to be kind of the dominant form factor,
Right.
but
Right.
whatever it is that a customer wants to use, we're ready for. I mean, we have by far the highest breadth and depth in the ecosystem. We're the market leader by many, many multiples. We're growing faster than anybody else and taking share. So wherever it goes, whether it's channels, whether it's AI, whether it's contacts, we're ready. We're
Yeah.
neutral, and that
L-
situates us very
Let
nicely.
me let me ask you a quick question on a slightly different topic. So, spam and security. You sit at the center of addressing this issue. How I was just talking to somebody in the newsroom earlier. I mean, two-factor authentication. It was great when it first started, and now even it is not protecting us from security threats. And then there's the whole spam issue. How are you dealing with that?
Yeah, there's two different topics there. So I'd sort of put spam and robocalling in one category,
Yeah.
and they're, look, absolutely devastating for the consumer. And, we hold ourselves to an extraordinarily high bar where we fundamentally disallow any kind of spam or robocalling to the extent that we see a customer to even take advantage of something like that. Like we use like very sophisticated machine learning, we call it drift detection technology, so that if a customer drifts even a degree from their stated use case, like we shut it off in the interest
Yeah.
of protecting the consumer. It's bad for the ecosystem. We spend a little bit of time even engaging on the Hill to make sure that legislators understand like what's going on. Certainly make sure that they understand Twilio's not behind it, but how do we work collectively between Twilio, the carriers, other ecosystem providers, to do everything that we can to make sure that this problem gets solved. On the on the security side, not cyber, on the security side, look, 2FA is still a great channel. And I think, what we do is kind of go one step further. And so we certainly use our 2FA capabilities and, anytime that you log into, financial institution, healthcare, what have you, it tends to be 2FA either through email or text message. I think there's a lot that we can also do and do for customers behind the scenes using advanced device fingerprinting where we actually know exactly what the device is that's actually behind the origination of the code to make sure that it is a much more secure experience. And so in our experience using Twilio products, we don't see compromises from a security perspective, nor much in the way of spam or robocalling.
And just, I mean, just to make it real for us, there's a conversation around, is AI making spam worse? Is it more of a threat for the security of consumers, businesses? From the way you see it, is it really AI that has driven the increase in spam? Let's focus on that, maybe that category.
I don't think so. I mean, I think it could be a factor in the sense that you could maybe go a little bit faster with this stuff, but I think that everybody that participates in the ecosystem fundamentally views this as like a bad long-term trend, right? And so I think there is like pretty broad alignment other than, some kind of fly-by-night style operators that this is not business that's, kind of worth being in. We also work very actively with the carriers. The carriers also have a lot of interest in protecting the ecosystem. I mean, if we're not using our handsets for voice, email, and text communications, I mean, that's like really damaging, for the ecosystem broadly, certainly for our business. And so I think we're all working hard to make sure that we control that. On the security
Right.
side, I think AI kind of cuts both ways, right? I think that it certainly has
Helps and hurts both, yeah, at
exactly, right? I
once.
mean, I think
Right.
we're all using it in ways that kind of create new force fields. On the other hand, like we're all like really worried about like what it could do in terms of finding new vulnerabilities. And so in our own business, we're attacking ourselves as much as we can using these same tools, using white hat operators, red teaming it just to make sure that our perimeter is controlled. But look, at some point, probably every company is going to have a bad day of some kind
Right.
given, what's happening in AI, and I think how you respond in that moment is really what differentiates you.
Great. Well, Kaz, I wanna thank you for coming on. That is Khozema Shipchandler, the CEO of Twilio, here on TITV. A new report released by Brex this week suggests that AI infrastructure companies that rent compute and are carving out a space separate from cloud giants are the fastest growing category of startups right now. To talk more about that data and about this segment of companies at large, I want to bring on Ben Gammell, president of Brex. Ben, welcome to the show. It's great to have you here.
Thanks so much for having me. Great to be here, Akash.
So we'll talk about the trends here in a second, but help me understand here. I mean, what exactly is the data here that you guys collected for this report?
So, as you know, Brex is a corporate card and spend management platform. And so, as a result of that, we have real time visibility into the spending behaviors of tens of thousands of customers across the US, across card and bill pay activity. The report really highlights the fastest growing vendors across our customer base. That being said, it's worth calling out that it excludes any companies that are publicly listed, have a
Hmm.
run rate of greater than $1 billion in revenue, or a valuation of greater than $30 billion.
Okay, so a nice look into the private markets here and the spending that people are doing. Together AI was the number one, the fastest growing company that you spotlighted. What's the story here behind Together AI? Walk us through exactly what their business is and why you think it's growing so quickly.
Yeah, so I think taking a step back, I would say a theme that we've seen with this report is that 14 of the 25 fastest growing vendors are companies that play in the infrastructure layer space. So think of this as compute, databases, and sandbox environments. As you called out, Together AI is the fastest growing amongst that subset. They're really focused on model refinement and helping customers that use AI models to train and improve their data. And so one of the things that we've really seen is by virtue of Together AI giving access to open source models, they're a fast growing group in this cohort.
So, I mean, look, Together AI, I don't think Base 10 or Fireworks were in this report that you guys specifically put out, but I mean, this is the category of AI infrastructure that we talk about on the show. Help me delineate. I can never quite get this right. Delineate between this group of companies and then the cloud companies and the model providers because they're all playing in slightly different layers, right?
Yeah, so the way that I think about it is I think of the closed loop models such as Anthropic and OpenAI as being equivalent to a restaurant. So you go and purchase a meal from said restaurant in the form of an output of an AI token. Whereas infrastructure companies such as Together AI enable you to use open source models. So think of open source models as free recipes, but you still need to go and purchase the kitchen, the equipment, and the staff to then run your AI products on top of. And so companies like Together AI and others that you've mentioned basically enable companies that are building AI products to leverage them for their backend work versus necessarily having to go to the frontier labs themselves. The reason for this is fundamentally cost. What we're seeing is that the open source models are sufficiently good enough to do more routine work. So think of that as data extraction, data processing, transcription, and that enables these companies to scale their business at 5 to 20 times cheaper a cost than as if they were to go to the frontier labs themselves. So really what founders and startups are becoming more sophisticated in is what work to route to the closed loop models such as Anthropic, OpenAI, and what otherwise to use an open source model and compute.
So are they just router companies then?
No, it's not so much that they're router companies, it's that they are essentially surfacing up the back-end infrastructure that these companies need to run on. If you think about any AI product, the two things that they need is compute to power models, as well as databases to store user and customer data. And so this infrastructure layer of companies is essentially giving AI startups access to that back-end infrastructure without them necessarily needing to go and build it themselves or otherwise be tethered to the large language models, which may be more expensive for some of that rote work.
Okay. So how fast is Together AI growing then according to your data?
So I won't send specifics on Together AI's growth, but what we're seeing is that this cohort of customer is seeing pretty remarkable growth by virtue of the pace in which companies are switching to open source compute models. And so back in 2024, we would see startups typically purchase open source vendors at about 12 months from their first big lab bill. What we're now seeing is that timeline is accelerating to as little as 5 months. And so companies will often get up and running, leveraging an Anthropic or an OpenAI. And then within 5 months, they will then look to work with a company such as Together AI to then work on the open source models for some of their work.
So what was the time period that you guys studied for this report? I mean, were you looking at was it like Q2 in terms of spending?
Correct. So it's a quarter worth of data essentially over
Okay.
the summer. And one of the
Okay.
things we've seen in terms of change versus previous reports is that previous reports, I think the fastest growing vendors were much more of the AI applications themselves and the AI products themselves versus the infrastructure layer that is now powering them. So think of those as the Lovables, Replets, Bolts of the world.
So it sounds like the open source conversation that we've been having here on the show, I mean, it's very much showing up in your data as well. Looking ahead, I mean, we're in Q3 now, to the I'm not going to ask you to preview the Q3 report here, but are you seeing the same trends? I mean, is open source really going to carry spending in the current quarter? If you had to make a prediction here, or are we going to go back to application layers?
I would say for the most part, for fastest growing, I would say, it continues to be the open source models. It's obviously worth calling out, like Anthropic just recently reported record rates of run rate in revenue. So clearly Anthropic and OpenAI are still growing at an immense clip. I think what we're just seeing is a more sophisticated approach to what work gets done between different model providers to make sure that the economics of a company actually stack up. Because you can get up and running very quickly with, the sort of applications such as Cursor or Replit or Lovable to build your application. But then as soon as you start to scale it, you really do need to think about, well, how are you going to manage your compute costs? How are you going to manage your database costs? Because those two line items can become very large as usage grows of your product.
Right. I saw another name that intrigued me. Higgsfield was the number 2 fastest growing company, and they obviously raised a big funding round in the last couple days. We it's a company we haven't yet spoken to on the show. We would like to have a conversation with them. What would you ask Higgsfield? What's behind their growth?
I think one of the things to ask them, and if I was a reporter asking them, I would want to understand concentration of their growth. I think what we're seeing is there's broad-based sort of adoption of their product and platform, and this is because we're seeing this reporting across thousands of customers and where they're sort of putting their dollars. But I think one of the things I've always wondered about a lot of these companies and applications is how concentrated is their revenue to any one customer. We see obviously on our side a pretty diversified revenue base for Higgsfield, but obviously that would be a question I would ask them.
Got it. Got it. You talk a lot about the companies that are growing quickly. Where are you starting to see growth taper? What segment of AI are you starting to see that in the spending?
So I think it's just more of what I mentioned earlier about how we're seeing this benchmarking report evolve over the last sort of several quarters, where this reporting, 3, 6 months ago was much more oriented around the AI applications and products themselves and less the sort of picks and shovels infrastructure layer. So I think that's been a real shift. Now, that's not to say that those AI applications aren't still growing
Yeah.
incredibly well. They're just growing at a less fast pace than these sort of infrastructure players.
Does it oscillate? I mean, in all the quarters you've done it, does it kind of, is there sort of a breakthrough and then everyone has to spend on infrastructure and then everyone says, okay, we have infrastructure, we got to spend on applications now. But then there's another breakthrough, you come back to infrastructure. Like, does it kind of oscillate in that way at all?
I mean, we haven't seen that oscillation yet in our data. That being said, I think the world as you know it in AI is evolving so rapidly. I think I would be a fool to try to predict where does the next 3, 6, 12 months go.
Right.
That being said, I do think that there is a continued evolution, let's call it, of what companies need as they go through different phases of scale for their products. And I think that's what we're essentially seeing now is we're seeing this move by virtue of the scale at which some of these AI startups are sort of reaching. And as a result of that, they're needing to sort of be more sophisticated in terms of how they manage their costs. One of the things that I think has always been a sort of a question mark that people have had is sort of are vibe coded apps actually real? I think one of the things that we're seeing on our side is because you're maybe using a sort of Lovable or a Replit to maybe prompt your application into existence, you quickly see that within sort of 3.5 months, those same companies that paid for one of those services are now going and paying for a paid production database within about 3.5 months. And that transition shows that these applications are getting real usage because you wouldn't otherwise need to go and pay for a production database if you weren't seeing traction in your product. And so I think it's more of an evolution of where the broader ecosystem is, let's call it, in terms of its evolution about where its priorities are. But that's not to say, to your point, that it doesn't now swing back in futures to potentially the AI application layer.
Right. And I think you explained that well. So I mean, the fact that these infrastructure providers are growing quickly is a nod to the fact that vibe coded applications are not just sitting unutilized; they're actually getting some traction. Whether or not they replace the broader software sector is a totally different question, but at least they're getting some use. I know you got to run very quickly. I'm just going to ask you one quick question, then you're going to come back on and talk about this more. The Capital One integration, Ben, how's that going? Just talk about that.
It's going great, to be honest. I think Capital One is an amazing acquirer for us as a business. If you think about the business synergies that exist across both businesses, given they are in the corporate card space. One of the things that I think is pertinent to this conversation, even around AI, is if you think about the amount of data that Capital One has across both consumers and businesses, and us being able to leverage that as we think about improving Brex's products and performance, I think is sort of unparalleled. And so we're really excited about all the tailwinds that come, not just from access to Capital One's balance sheet, but also all of the rich data that they have amassed over many, many years and many, many customers that we can then use to make our product more compelling.
Is Together AI, or is AI infrastructure the fastest growing segment of software spend for you guys as well?
It definitely is becoming a line item in our P&L.
I mean, are you doing all these? You must have these
managing.
vibe coded apps that you're running right in the background, or but
Yeah.
I don't know. Maybe Capital One, it's a regulated industry, or maybe you can't do the vibe coding. I don't know.
Yeah, I think vibe coding is probably less the build, but it's more about how do we build AI into our product, and definitely by virtue of that, our compute is going up quite considerably. So an active conversation between us and our CFO is really around how to manage those two line items.
Great. Well, as a former CFO yourself, I know that is top of mind for you as well. Ben, I want to thank you for coming on. That is Ben Gammell, president of Brex, here on TITV. That does it for today's show. A reminder, we are on this stream Monday through Friday at 10 a.m. Pacific, 1 p.m. Eastern. If you can't make it then, episodes are available on theinformation.com, on our YouTube channel, or wherever you get your podcasts. Make sure to follow us on social media on X, Instagram, TikTok, and LinkedIn. I am already excited for our next show tomorrow. Have a great rest of your Tuesday. Bye-bye for now.